My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Every time you're tempted to believe we can mount a significant rally, you have to recognize that by the time anyone's thinking like that, the rally already seems long in the tooth. Look what happened today. The Dow ultimately gained 338 points, S&P climbed 1.14%, Nasdaq advanced 0.90%. But, that was down substantially from where it was earlier in the day. Why? Because every advance in this market is predicated on so many things going right. The dollar being stable, interest rates staying steady or going lower, oil not going up, sentiment remaining negative enough that everybody who is going to sell has already sold. Sell, sell, sell. Notice what I didn't say these moves are predicated upon. The stocks themselves. Sometimes I think they've become tiny playthings, maybe tiles in a giant game of rummy cube, or some plastic ball with holes that goes by the name of pickleball. Today, for example, we got results from Goldman Sachs, Lockheed Martin, Johnson & Johnson, three of the most important companies in the world. You know what? All three were excellent. But you know what shined the brightest? Lockheed. Why? It vaulted 9%. You know what happened? Yeah, okay, sure. There's a war going on in Ukraine. They need our merchandise. But more importantly, going into the quarter, money managers were getting calls from the brokers that Lockheed would miss its projections and fail to return capital to its shareholders. Now, I have no idea how these rumors got started, but that's the reason for this turbocharged rally. So many people were betting against Lockheed, and when the numbers were good, those short sellers had to buy back their stock in order to close out their position. And that, I think, is a microcosm for the whole market. The stocks that run up the biggest, the indices that roar on certain days, are often a function of how few people remain in the market and how many money managers are terrified of a rally because they've taken the other side of the trade. The one thing these people aren't doing, they're not investing. That's right. The people who are moving huge sums of money in and out of stocks barely seem to even care about how individual companies are doing. They're all about the SPOOs, meaning the S&P index futures. They are no different from betting on wheat or corn or oil or sometimes, honestly, I feel red or black, like at the roulette wheel. Now, I've railed against this issue for ages, but this time it's different. Why? Because as much as I like J&J or Goldman Sachs, and I am a fan of both, right now they're treated just like bushels of wheat, and they're not bushels of wheat. And that bushel goes down in value every time interest rates go up, regardless of how the companies are really performing, and they're performing perfectly. It is so unnerving to me because it keeps us from putting together strong back-to-back-to-back sessions. I went 2 or 3 in a row. It makes you want to give up on the whole business of investing, which many of you are, because the whole market's hostage to interest rates. Let me give you another example. Today, an activist firm called Starboard Value made a presentation about how Salesforce, the stock, is undervalued, in part because management has been running things to generate, and for sales, not for earnings. They've been more focused on revenue, market share, overall dominance. Now, I could go deep in the weeds here. I'm going to talk about this later, by the way. I know Jeff Smith, who runs Starboard. Good relationship with Mark Benioff, by the way, the co-CEO of Salesforce. And they share a common goal, a higher stock price. It also helps that Benioff recently adopted a more hardline approach toward profitability. He cares about the earnings now, not pursuing growth at any cost. But what strikes me here is that all of this is irrelevant in the current environment, where enterprise software stocks are totally out of style in what I always call the Wall Street fashion show. Without a large dividend, one that gives you a higher yield than you can get from the 2-year Treasury, currently at 4.4%, along with a cheap price-to-earnings multiple, it's impossible for Salesforce to buck the trend more than a day or two before slipping right back down. That's the nature of this particular beast. You need stocks that can escape the clutches of oil, of interest rates, of the dollar, of inflation. And that's very hard. Hey, listen, take Netflix. They just reported, right? They reported a magnificent quarter this very evening. Saw its stock soar. Netflix delivered a monster 96-cent earnings beat off a 214 basis with 2.41 million new subscriber additions. When Wall Street was only looking for a little more than 1 million. They also gave excellent subscriber guidance for the next quarter, and they told a compelling story about the new ad-supported tier. I liked everything. Now the stock of Netflix is roaring, some short squeeze, but as great as it is, it's definitely not great enough to get the stock back to 700, where it was trading before the Fed declared war on inflation. You better believe this rally would be much, much bigger. Maybe up 50, maybe up 100 points if it weren't for the strong dollar, the bond market, raging inflation, oil. So what do? I don't want to encourage trading. Most people simply don't have the time to trade. Very hard to do if you got a real job. That's why I encourage you to find businesses you like, preferably ones with dividends that sell at inexpensive price to earnings multiples, so you can buy their stocks into weakness. Think of it like this. If you love Netflix's programming and you decided to buy their stock at this time last year, you paid nearly $700. When it didn't make its projections, it fell to the low of 160. If you tried to buy this thing on the way down, you would have gotten eviscerated because it's got no protection. Only multimillionaires can afford those kinds of losses. Now, if you are buying the stock of an oil company that spews cash and supports an 8% dividend yield, or a pharmaceutical company that makes successful drugs and offers a high yield, then I think you can ride things out by buying more stock into weakness. These equities absolutely get cheaper as they go down, and their dividends cushion the blow. As for Netflix, I like that the company's turning itself around. But the next time we get some aggressive commentary from the Fed, this thing is going to get hit all over again. If you buy it here, you may be pressing your luck. I would rather have you own the stock of Disney. Charitable Trust owns it, which hasn't moved yet. It's got a similar business model for streaming and could benefit from an advertising stream. Now, there have been other markets where I would say, let's go for growth here, recognizing that it's fine to overpay for growth stocks. In fact, I did just that for Salesforce.com for years, and it was a big winner because we weren't worried about the Fed or the bond market, or inflation, oil, PPI, CPI. We didn't have to run a horrible gauntlet for stocks to rally on good news. And stocks weren't pickleballs or rummy cubes. That's not how it is right now. Recognizing what kind of market we're in, a treacherous one where good earnings aren't enough to move a stock much higher. Remember, like Lockheed, like Netflix, you need people betting against that stock in order to have it soar. The bottom line, you have to resist the urge to rent stocks because you'll get evicted when they inevitably decline in price. Instead, you should be willing to own your favorites that have dividend and valuation protection and buy more into weakness because this market's making so many stocks so cheap. And eventually we'll stop being hostage to the Fed's war on inflation, and you'll make a lot of money. Until then, though, buckle up because it's going to be a very bumpy ride. Let's go to Dan in Pennsylvania. Dan!
Hey, Jim.
Dan, what's up?
Not much. You tell me, Jim. I hear when you walk into a room, the
Netflix is
lights
up. Well, I mean, wait, let's try to make some money together. What's going on?
I'm looking to possibly purchase some Visa stock.
You know, I was working on Visa today because of some problems with maybe the Senate. And I'm going to have to discourage you from buying Visa right now at 187. It sells at 25 times earnings. That's too rich, even though I think it's a great company. I do prefer MasterCard a little more, but those are expensive, and I don't have any appetite for expensive stocks right now. Let's go to Steve in Virginia. Steve.
Hey, how you doing, Jim? I like to say booyah. Other than that, I'm a member of the investing club. I think it's a bargain. I think I really appreciate what you do for us retail investors.
Yes. You just made my day. That's what we work on all weekend. We do it every night. I do a nice piece, by the way, Sunday night for everybody. Even after an Eagles victory, I take time out and I write that piece. What's going on?
Well, Constellation Brands, okay? You recommended it. Sounded great. I watched your interview with the CEO. I was going to go pull a trigger, but I noticed the PE ratio was almost 700. So
no, that's not the real one. It's a much lower one it's exaggerated by some accounting issues. I want you to buy the stock. I think they had a great quarter. It is way too cheap. STZ, that's one to buy. The trust has it. The trust wants more of it. Now, you have to resist the urge to rent stocks. Just own your favorites with dividend protection, with low multiples, and buy more into weakness because this market is making many stocks very cheap for the long haul. And we're going to get off this wild ride someday. We'll make money tonight. Vici announced after the bell a new partnership with Canyon Ranch, one of my places to hang out, giving the experiential REIT some exposure to the wellness space. So I'm digging into the details top and bottom. Then J&J reported earlier today. So what should you make of the results? I'll give you my take. And the pharma space has some fresh faces on the street. So I'm giving you the info you need to know about 3 of these names, including one that you asked me about just last night in the lightning round. How's that for service? So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.